Hey guys, Joseph Henson here with Henson CPA Group. I hope you have had a great week. It is now 10/16, October 16th, and we are through the extension period for your tax returns. So this week we're going to start talking about something a little bit different. We're going to talk about the hidden power of your balance sheet, what veterinarians overlook, a practical guide for veterinary owners. Again, I'm Joseph Henson with Henson CPA Group. I'm glad you guys are here joining me today. And if you have anything afterwards that you'd like to discuss, feel free to send me an email and we can talk about it there. Why does the balance sheet matter? Why? Why should you care about your balance sheet when you have your profit and loss or your income statement, or you have your bank account that tells you where your funds are? Most owners are only focusing on their P&L, their profit and loss, their income statement. All three things are considered the same thing. The balance sheet will show you what your clinic owns and what it owes. So what you currently have in your possession or should be coming to you and what you owe to other people. Banks, buyers, and investors pay close attention to it. They care about your income statement, but they also care about your liquidity, how much capital is on hand to pay debts that are coming up. It will tell the story of long-term financial health more than just where did we spend money. You will be able to tell a lot by looking at your balance sheet you will never see on your income statement. What a balance sheet shows. There's some main areas. If you ever took an accounting class, you would know your assets equal your liabilities plus owner's equity. So what are the assets? Assets are cash, equipment, inventory, accounts receivable, short-term, long-term, it doesn't matter. This is where they are. And with cash, you can have cash and cash-like items. So if it's something you can cash out fairly quickly, like a CD, we're still going to count it in the same sort of area. Liability. This is where you're going to see your loans. Do you have a building loan? Do you have a car loan? Do you have a loan for a bank just because you need a little extra cash? Credit cards and payables. So this could be accounts payable. This could be shareholder payable. There's a lot of things that can go into this, but those are what your liabilities are mostly made up of. Equity, owner's investment, and retained earnings. What are retained earnings? This is what the owner has in the company available that has not been distributed as a dividend or as a shareholder draw. Now, this is a snapshot. This shows where you stand today. Typically, you're going to look at this as of period end. So as of September 30th, 2015, I had this much in the bank. I had this much in assets, this much in depreciation, this much in liabilities, and this much is within owner's equity. These should balance. Your accounting software should not allow them to not balance. Your assets should be equal to your liabilities and owner's equity. So if you have $100 in assets, total assets, $80 in liabilities, I better see $20 on your owner's equity. If they don't have that equation there, if it's not matching, we've got a bigger issue. There's some cleanup to do, and it's going to be a lot of work. Your assets, they tell a story. Your cash reserves show how well the clinic can weather its ups and downs. If you are in a cash burn, so you are spending more than you bring in, your cash reserves might show you only have 2 months left to operate with current expenses as they are. Otherwise, if you're in a cash surplus, you are constantly bringing in more income than what you're spending. You'll see your assets go up, and that is a great thing. That's what we want. Accounts receivable. These are your unpaid client balances. If this is growing month over month, year after year, and you're not seeing this drop, we have an issue, especially in the day of care credit and being able to say, here's a way for you to pay that doesn't put me on the hook. It's one of those things that you should keep this minimal so you're not losing out on $10,000 because someone decides they're not going to pay for that surgery that took you 10 hours. Extreme example, I know. I'm just throwing out an example. Equipment. This is the reinvestment into the practice. So every time you go out and buy an ultrasound machine, an x-ray machine, this or that. These are equipments that we are putting on the balance sheet. If it's over $250, it should be here unless you make a de minimis election, then it's $2,500. Inventory. Often, this is one area that is very mismanaged. It is very bloated or undervalued. Inventory is something you have to take physical count of. Most of your software is not going to talk to your books. So you need to know what inventory is on hand and make periodic adjustments, monthly, quarterly, semi-annually, or annually. Because if you don't, you need to do this at least as of 12/31 every year so you know your inventory is accurate. If you don't, you are going to either overstate or understate your income statement. You need to also have some areas here that will limit what people can take and have processes in place so that you don't have theft. Liabilities that can sneak up. Short-term debts like credit cards, vendor bills, and payroll liabilities are debts that can really sneak up on you if you are not prepared. It doesn't seem like it, but if everything is put onto a credit card, you want to make sure that you're paying that credit card off monthly to minimize how much interest you're paying. Long-term debt, these are the equipment loans, these are the building mortgages, the ones that you have, you're paying off periodically every month, you know what the interest is. It should always be going down, 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 unless you took out a new loan, obviously, to purchase a new piece of equipment, do an expansion on your building. The thing with long-term debt, if you get right down to it, you should have a short, less than 12-month portion and a longer than 12-month portion. Most people don't do this. It's very overkill in some areas. Debt to asset ratio. How leveraged is your clinic? How much debt do you have versus your assets on hand to cover that debt? If you are over leveraged, you will see financial stress and limited growth options. It's hard to get someone to loan to you if you're over leveraged. And also, it's hard to get someone to buy into your practice if you are over leveraged. Owner's equity. What is left after you take your assets and less minus liabilities? These should be whatever's left in the company. So you had, again, $100 in assets, $80 in liabilities. That means you should have $20 in owner's equity. It will represent your investment and accumulated profits. So if you put $100 in to start, and every year you see a $20 profit at the end of the year because you spent less than you earned, you're going to see that next year your owner's equity should be $120. The year after, same thing, $140. The growing of equity shows financial stability and higher clinic value. The more equity you have in the company, the better. That's not saying don't take money out, but it's not a bad thing to show good equity in your company. Negative equity is a warning sign. You have been losing money hand over foot, or you've been taking money out of the clinic more than it's bringing in. You're probably over leveraged and you're in an area that's going to hurt potentially in the short term and definitely in the long term. Balance sheet ratios every veterinarian should watch. I have some examples and I have some formulas. Your current assets, which is just your current assets divided by, or your financial category will be some of the areas you need for this. And it's going to be current assets, current liabilities, total debt, total equity, cost of goods sold, and average inventory. Some of the formulas you should be looking at is your current ratio. What is your current asset divided by your current liabilities? In our example, we have $150,000 in current assets. We're going to divide that by $50,000. That means our current ratio is 3. What does that really tell us? Hey, we have enough cash on hand and current assets on hand to be healthy. A debt to equity ratio, total debt divided by total equity. How much debt is it that you have in the company versus how much equity you have? So let's say you have $250,000 and you have total equity of $300,000. You have a debt to equity ratio of 0.83. Not a bad ratio. You're keeping it below 1, because if you have too much debt, that means what you have available in equity couldn't cover it. Inventory turnover. This has your cost of goods sold divided by your average inventory. Beginning balance plus ending balance divided by 2. And that is something that says how long does it take you to turn your inventory over. Here's some more things that you should really be looking at. And these are some ratio values that we talked about. Over here, we would have had a beginning inventory, turnover current ratio of 3, debt to equity ratio of 0.83. Common mistakes that owners of veterinary clinics make: ignoring the balance sheet until tax season. What do I mean? You don't look at this. You're not worried about where your balance sheet is because you want to look at your income statement, your profit and loss statement. That's what you care about. Do I have enough here to do what I need to do? Confusing profit with cash or equity. Just because you had $100,000 in profit doesn't mean you have equity of $100,000. If your liabilities are $10,000 a month and only $2,000 of that is hitting your income statement, that means $96,000 of cash went out that isn't on your income statement. That is huge. Carrying old, inaccurate balances, uncleared checks, and outdated accounts receivable. You need to verify what you're showing is an accurate representation of where you are today. Otherwise, your numbers don't matter. We want to make sure your accounts receivable is matching your Vetter, your EasyVet, your Avamark, whatever software you are using. Not reviewing trends month to month. If you notice that your trend is during the winter months, you're going down, down, down because people are focused on Christmas, they're not bringing their pets in as much until January, because then everyone buys a pet in December for their kid's gift. Phenomenal idea, if you ask me, obviously, but it's something that happens. You want to be able to see that proactively, not retroactively. Why it matters for your future. Why should you care what your balance sheet looks like? Banks use it for loan approval and line of credit renewals. If you are too risky, they're not going to lend to you. They don't want to take a giant risk, because even if you are collateralizing your clinic, they're not veterinarians. They're in the process of making sure they can make money. Buyers and partners will use your balance sheet as one of the ingredients to value your clinic. They want to make sure that if they see your debt to equity ratio, your current assets, your current contributions, all of this is out of whack, they don't want to truly invest with you. It will help you plan for expansions, equipment upgrades, and staff investments. Do you have enough on hand to expand your clinic? Do you have enough on hand to upgrade that X-ray machine that's 20 years old and you have to hold it just right to get it to work? Do you have enough on hand to go ahead and either train your staff more to invest in them, or invest in your staff by growing how many people you're working with, whether that's another veterinarian or a registered vet tech, an office manager, whatever it is? It will also prevent surprises at your end. If you do this correctly, you're not going to all of a sudden have a $50,000 tax bill and $10,000 in the bank. Understanding your balance sheet isn't just accounting, it's strategy. If you are not sure what your numbers are telling you, we can help you interpret them and guide you with it. Again, I'm Joseph Henson with Henson CPA Group. We are veterinary financial experts from A to Z. We want to make sure we're there for you. If you guys have any other questions, here's my email address, joseph@hensoncpagroup.com, 2 E's in Joseph. You can visit our website at hensoncpagroup.com. We have one site specifically for you veterinarians. Feel free to reach out. Email is always the best way. But until next time, I will talk to you